Welcome, everyone, to Let's Talk Real Estate Investing. In this series, we talk to real estate investors and we speak to real estate experts. And when I mean experts, I mean people that will help you, will be part of your team, that will help you build your business, such as, mortgage specialists, accountants, lawyers, property managers, etc. And the whole premise around this series to help you to build your personalized real estate investing strategy. Each of us are different, so each of us should be building our strategy based on who we need, who we are, what are our skills, what are our preferences, etc. So in this series, we talk to a variety of real estate investors and these experts to help you build that, give you ideas on how you can build your real estate investing portfolio and how you build out your strategy. For me, I am a real estate investor, and I am also a real estate investing success coach. So I help my clients as a coach build their personalized real estate investing strategy and scale efficiently. So we work on building in tools and processes so that you can scale efficiently from the start. And so that you can build out your portfolio as big or as small as you want to, and start enjoying financial freedom as early as possible, but also time freedom. Many of us are doing this financial freedom thing in order to give back time. So why not build in time freedom as we build our business? Today, I am really excited to have with us Matt Lipman. Matt is a CPA, and I'm going to read his bio to you so I don't miss anything. But Matt has been practicing as a chartered accountant for nearly 10 years now. He went to Concordia University and graduated from the program in accountancy in 2014. And then he completed CPA Canada's 3-year in-depth tax program in 2017. So I accentuate on the tax part of it because many of us are looking at how to pay less in taxes and how to do it efficiently. So Matt started his career at a Big Four accounting firm in downtown Montreal, where he stayed for 5 years, and he left to start his own practice, Mogul CPA. It's a new age accounting firm with a goal of exclusively providing services for real estate developers, property managers, and investors. So specifically for us, right? Mogul seeks to go beyond the traditional accounting and bookkeeping services by ensuring that their clients can actually extract meaningful information from their financial data to drive key business decisions. So we all need that. We need to know where we are. Is this property or is this investment really getting us to our goals? How much are we actually spending? How much are we actually making? And that's quite different to when we look at it from a tax perspective, because we're looking to write off as much as possible and show as little income there. So, I was really excited when Matt told me about what he was doing, because it really, goes with our goals as real estate investors. So Mogul CPA seeks to revolutionize the internal accounting team and process for their clients. By doing so, their clients avoid the costly recurring fees and they reap the benefits from a sophisticated finance department. So I'm going to ask Matt exactly what this means in layman language. Right? So, but before we get there, Matt is also a real estate investor. So Matt, can you tell me a bit about your real estate investing journey so far, and then we'll get into the accounting side of things.
Absolutely. Thank you for the lengthy introduction, Debbie. I'm happy to be here. So yeah, I got into real estate after my education and kind of working with some clients at Deloitte at the time. I just became interested in the real estate business. I found it fascinating. I like to say putting heads in beds is something that everybody should strive to do, and it's a problem here in Canada. So it's good to deliver value in the market. It's something that I'm focused on. So in terms of my real estate career, I think I started off. I started off with a triplex back in 2015, and then a couple of years later, I bought my second triplex and was all of that. I was managing it all internally. I was doing all of the accounting for it while I was obviously pursuing my career at my own accounting firm. And subsequently to that, I sold both triplexes, and now I'm in the nursing home space. So I'm working with old age folks, and I've invested in a couple of syndications that promote these types of deals. And really, I'm trying to carve out a space for me and for my real estate portfolio that's more or less focused in that industry.
So why, Matt, what appealed to you about why the transition to seniors nursing
Well,
home?
I think it's a growing market. My way that I do business, the way that I think about business is always about delivering value. And I see that there is a need for more development in that sector of the market. Especially here in Canada, there's an aging demographic. This demographic needs to have its needs met. It's important for, the goals of the nation to, of course, accommodate the elderly, the aging population, and make sure that they're well taken care of, right? So that's kind of where the source of it came from. And then, of course, working with clients that are in this space also helped me develop my understanding of the business from, a financial point of view and accounting point of view. So it really gave me some tools to allow me to do due diligence on certain deals before investing in them.
Excellent, great. So, do you specialize, Matt, in real estate? Working with developers, real estate investors, active, also active real estate, people like property managers, etc. So why the transition from working for Deloitte, where, you're working with many different industries, to why specialize in real estate investing, and how are you, doing that?
Well, Debbie, like it's a bit, I like what you said in the introduction in terms of like, everybody that's an entrepreneur is on their own path. They have their own goals and they're going to approach them in their own specific ways with their own specific strategy, right? So the reason that I decided to really specialize in real estate is because it's really impossible from an accounting or tax point of view to know everything about every business. There's just so many changing variables all the time. The market is changing, the rules and regulations are always changing. So, in order to provide the best value to my clients, and I think all accountants should really try to specialize in a specific industry. That way, they could deliver more value to their clients by knowing all of the rules and regulations that are changing and staying on top of them and being able to advise their clients not only after they happen or months or years after they happen, but like before they're happening. So we could be proactive in our approach and make sure that we're taking advantage of any advantages and avoiding any disadvantages that are allowed under the Income Tax Act.
That's amazing. That's what we need. We need somebody that is on top of, because as we can see in the last year, like there's so many new regulations that have come in. It's been rather crazy.
Yeah,
So
yeah.
it's been so let's drill a bit deeper, Matt, into your, what you do as with your company, with Mogul, because you're not just a charter accounting. You've got bookkeeping services and you have other services. So how can you
Yes.
help me as a real estate investor?
Yeah, so we're thank you for asking. We're really focused, like as we discussed, on the real estate space. So, largely I can help you with any of your accounting or tax needs inside the real estate space. Um, but we do focus on one specific offer that my firm is actively promoting right now, and that's the Supercharge Your Accounting Department product. So what that consists of is that for real estate businesses that, are kind of in between outsourcing their accounting work to an accounting firm and hiring somebody internally to handle their accounting, like a bookkeeper or controller. My team actually comes in and offers something that's in between the two, that's probably better suited for a lot of entrepreneurs out there. And basically, the first step of what we do is that we go out and we hire you an outsourced accounting professional that's overseas. So we have a very lengthy due diligence process of finding these accounting professionals overseas. So we go and we find this person and we bring them into your business. So you hire them, you pay them directly. There's no markup on the monthly fees that they charge you, and you manage them directly as well. So this person will come in, they'll do 95% of the accounting work for you, including all bank reconciliations, accounts payable, preparing invoices to tenants, whatever the case may be. This person will be managing all of that process for you and taking and putting a lot of time back onto your plate. The next step in this product is that we build out the standard operating procedures for your newly hired accountant to follow. So we come in, we study your business, we learn about what your accounting cycle should look like, we optimize it, we put it on paper, and we iron out the details so your newly hired accounting professional has a roadmap so that when they come in, they could follow this guide, these standard operating procedures to make sure you're getting consistent results from your accounting department on a monthly, weekly, or whatever interval basis you need. Then the last thing that we do is that we actually review their work. So we stick on for 3 months and we make sure that they're actually performing well, are consistent, highly competent, offshore professional to handle all of your books and records for you, so that you could save a lot of money and time and focus on growing your business.
Awesome. Thank you so much. That's exciting because as for when it comes to like accounting for myself too, when I had at one point a bookkeeper that was outside that I hired, and then I had an accountant, and it was really difficult for those two to gel because like the GL numbers and what the accountant wanted and what the bookkeeper prepared wasn't always in sync. So it was always difficult and more work. So I love that service that you're helping us find someone that's offshore that's actually cheaper, but then you're training them to do it your way so that when those books now, move from just the bookkeeping into the accounting side of things,
Yeah.
doing all of the taxes and the balance sheets, etc. That it now you don't have that extra work. So that's so exciting to hear.
Oh yeah, absolutely. I think the accounting space is something that's been missing some innovation over the years. Obviously, it's a huge market, but it's been quite traditional, um, and lacked some innovation over the years. So I think, this product really brings more value to the clients up front, and that's my goal, is to see my clients save money and time so that they could grow their businesses.
Wonderful. Now,
Mhm.
I want to get into now some of the a big question that everybody's talking about these days. One of the changes that have happened recently that
Yes.
everybody's like, I'm hearing different things from different people. There's so many myths that are out there. So I want to get into specifically the flipping tax and
Oh,
and like around that, like what is the difference between business income and like capital gain? So if we can cover some
yes.
of that.
Yeah, I mean, yeah, the space has been pretty crazy. The real estate space in Canada, of course, there's a Canadian housing crisis. That's what the news outlets have labeled it. So I think the flipping tax is a result of this issue that Canada is seeing across the nation of, housing the cost of housing just skyrocketing, right? So what the flipping tax is a government measure to kind of decrease the amount of volume of transactions seen in the real estate market, right? So so what so that's exactly what flipping is, what you mentioned, right? So what flipping means is it refers to business income, right? So when you're generating flipping income, it means the same thing as generating business income. And the way to kind of distinguish it, from a conceptual point of view in your own head, is that business income is like selling inventory, right? It's like selling, so let's say, widgets. It could be a pen or a cell phone case or a booklet, right? So when the government basically considers the sale of a property as flipping income when you're in the business of selling property, right? So the property is kind of being viewed as a pen or as a booklet, as a piece of inventory. Okay. Whereas capital gains, or is viewed as passive income, and that's generally when a property, the intention of buying the property is for a long-term use, right? So the difference between, I should mention that the difference between business income and property income is really the inclusion rate. So, capital gains are included in your income. 50 to 66% of capital gains are actually included in your income, whereas business income, of course, 100% of it is included in your income. Okay. Um, so now that we've kind of made that distinction of what flipping income and business income is in comparison to capital gains, I think it's important to understand when something um, is considered business income and when something is viewed as capital gains.
Mhm.
Are you with me so far?
Yeah.
Yeah.
So let me paraphrase. Let me see if I got this right. So when it comes to flipping, like the flipping tax, that thing is business income. So if I'm in the business of buying a home, fixing it up, sell it, buy, fix up, sell it, or have several going at a time, that's considered business income, and it's taxed as like the full amount of it. Is taxed at X%, which you'll tell us more about.
Yes.
However, when it comes to capital gains is something that I've held on to, and then I've sold over time. It's something that's
Yes.
passively done, and some of that income is considered in like a percent of it is considered capital gains, and a percent of it is considered as regular income. Is that right? Or is
No,
not even
actually,
considered?
a percent of it is, so for capital gains, only 50 to 66% of it is taxable. So
So the
uh,
rest is like it's
the
sheltered.
rest is just free. Yeah, the rest is tax free.
Okay,
Okay.
right.
But yeah, that's largely that's conceptually, I think you got it.
Mhm.
That's the difference between business income and capital gains.
Mhm.
Um, so yeah, I think the next step is in understanding this flipping tax, right? Is
Yeah,
that
because we always had like flipping was always considered business income,
yes,
right?
exactly.
Yeah.
It was always considered business
So
income,
what's
but
difference now with this flipping tax?
well, no, actually, flipping was always considered business income.
Mhm.
It never changed, right? But now the government is basically being more aggressive in finding these people that are flipping properties and trying to catch them and you know assess them as business income rather than capital gains. I
Okay.
think there's a lot of political pressure to get the housing market under control. So there's been like the CRA has been much more focused in going after these transactions that may be viewed as business income, assessing the taxpayers as such. And then, obviously there's an appeal process that you could go through to fight for, the capital gain viewpoint.
Mhm.
Um,
So what's that period of time that is considered to say, like, I've bought a property today,
yeah,
and what period of time, if I sold that property, is that considered flipping?
right. So the thing about the distinction between business income and capital gains is that it's actually not defined in the Income Tax Act. So it's defined by case law, which basically means that it gets a bit murky. It's like a gray zone, right? So there's certain legal tests that are looked at by the courts to determine whether it's a capital, if it's a business income or capital gains. And the first test that they kind of look at is well, there's five tests. There's intention, length of time or period of ownership, the improvements that you've made to the property, the frequency of the transactions, and whether it's personal use or for investment use. So we'll dig into that just after.
Mhm.
Now, one of the rules that was recently implemented um, is that a if you buy a residence and then make improvements to that residence and sell it within 365 days, then automatically the CRA is going to assess it as business income. Okay. So if you're trying to, take the position that um, the piece of property that you sold should be viewed as a capital gain, then you most certainly need to wait at least 365 days after acquiring the property to sell the property. Otherwise, almost guaranteed the CRA is going to reassess you as a business income sale. Okay. Now, if you hold on to the property for longer than 365 days, well, what we've been seeing is that the CRA is still coming back and reassessing those sales as business income. Okay. And really, it comes down to largely the intention that you had when you acquired the property, um, to distinguish between whether it's business income or capital gain. So, if you want to be able to argue with the auditors that your intention was actually to live in that property, right? Like you want to have, something that you also want to be able to show that you've actually lived in the property. So, some things that could help with that are, let's see, like receipts from the movers, right? Showing that you actually moved your personal property into this home. Probably definitely you will want to have changed your mailing address to this new property with the CRA and Revenue Quebec. That could be a big red flag. So you want to do that ASAP, a second after you acquire the property. You'd also want to show that you've probably changed your kids into a
School
school
district.
that's closer to that property. Um, and I guess photos of you guys like living in the property and enjoying the property would also be something that an appeals court would look at, right?
So Matt, did the percent, like, did the percent when it comes to homes, like investment, also increase? So say my personal tax bracket was, I don't know, was I don't know, 15%, just something like that, right? Um, if would the money, the business income that I make, right?
Mm.
Then be taxed at the same percent, like add on, that money, and then would it just be taxed at a regular tax bracket? that whatever my income tax bracket would be, or is that a specific percent specifically for flipping?
Yeah, so I think
That makes
maybe
sense.
maybe we could just look at a couple of distinguishes that this or a couple of different examples. Um, and I'll explain to you the tax consequences behind each example. Does that sound good?
Yeah, so let's start with, of someone that's doing it under their their personal their personal name, right?
Yeah. Okay, well, of course, the easiest one to describe is that, um you and your family go out and purchase a home. Let's say you buy the home for $500,000. You put $200,000 of renovations into the home, right? So your total cost would be 700,000, right? And then you sell the property for $1 million, right? So, you have $1 million sales price. Your total cost of the home is 700,000. So you have a gain here of $300,000, right?
Mhm.
So of course, if you lived in the home and you qualify for the principal residence exemption, that $300,000 would be completely tax free. You would not be taxed on that $300,000, right?
Right.
So, you know, just there, it goes without saying that you should plan for making sure that you will qualify for this principal residence
Doing the
exemption.
things you said before about like the school district, the changing your
Yeah,
address, etc.
exactly. Um, Now, let's say let's say you're renting your principal residence, right? And you went out and instead of buying a personal residence, you bought an investment property,
Yeah.
right? So you paid $500,000 for that investment property. You put in, let's go with the same example, $200,000 in renovations to that investment property, and you then sold that investment property for $1 million, right? So you would have again a $300,000 gain. Now, if that gain is viewed as a capital gain, right? So, the primary intention when you went into purchasing this property was to rent it out for a long period of time, collect rents, and then maybe eventually sell the property down the line,
Hmm.
right? Um, the on the $300,000 of taxable income, um, because you're an individual, the inclusion rate for capital gains is 50% up to the first $250,000. So on the first $250,000, you would include 125,000, and then there would be an extra $50,000 on top of the 250 to get to $300,000, and that would be taxed. Would be included at 66%.
So the
So you would
50,000 would be taxed at
125,000. You have a gain of $300,000,
300,000.
right?
Yeah.
So you would basically end up including $158,000 into your income,
Okay.
right? And that would be taxed at the marginal rate, right? So, um, the highest marginal rate in Canada is 50%. So, 50% on 158,000 is something like 79,000. Um, so that would be the total taxes due on that transaction,
Okay.
right? So
Mhm.
let's keep that number in mind,
Right.
79,000. So obviously if you qualify for the personal residence exemption, you'll be taxed $0
Zero.
on the state,
Right.
right? Now, if it's viewed as a capital gain, you'd be taxed $79,000 on that transaction.
Okay.
Now, if it's a business income, the full $300,000 gain is actually included into your income,
Right.
right? So, um,
So if I was
so
working for 100,000 for that, and then that year I have a salary of 100,000, that
yeah,
that will then 100,000 plus the 300,000 So
If
now I'm being taxed at 400,000 minus expenses, of course, right?
Yeah, exactly. So let's say you're in the highest marginal rate. So we keep it consistent with the prior example. So that $300,000 would be taxed, the highest marginal rate in Canada is like 52% or something like that. So let's just say 50%. So you would actually end up paying $150,000 in
Oh,
taxes on that
right.
$300,000 gain. So $0 in taxes if you qualify the personal residence exemption, $79,000 in taxes if it's viewed as a capital property and a capital gain, and $150,000 in taxes if it's viewed as business income. So as you can see, there's like major tax consequences depending on which part of the Canadian legislation you fall under.
Right. What if now I'm doing this under a corporation? So let's talk about the, less than a year or like a capital gains situation where I've held it, rented it out for a year, or so, and then, decided to sell it after renting it out. Say the tenants leave, my mortgage is too high, and I decide I can't, I don't want to be a landlord anymore. I'm going to sell it.
Yeah, listen, I think that under corporations, there's certain disadvantages, right? Like um the $250,000 limit that's taxed at 50% rather than 66%,
Under the
that only
capital
exists
gains.
on capital gains.
Mhm.
That only really exists for individuals. So right off the bat, you're at a disadvantage from a corporation point of view. There's many different other tax consequences. The corporation taxing of investment income can be a bit complicated. I don't want to drown our viewers with more numbers. But maybe on our next call we could
We can get
discuss
into
that.
the capital gains side of things. Let's talk about flipping specifically in a corporation because it's business income, right? So how is that taxed? Is it just taxed as an active, like 11% or whatever it is? Or is it
It, it's
higher?
it in order the thing about corporations is that it's actually favorable to have act to be taxed as business income, right? That's because in corporations you get the small business deduction, which lowers your tax rate to 11 or 12%, depending on which province you're in, right?
Hmm.
Um, Now, the thing is that if you're flipping inside a corporation and you don't have five or more employees, then you will not get access to that small business deduction. So your corporate tax rate will be significantly higher. So, it's again, I don't want to I think that we're getting into the weeds of everything now, and I don't want any viewers to make rash decisions without consulting a tax professional. Every situation is different, and there's definitely a place for corporations. There's many other structures that taxpayers can use to mitigate and plan for their taxes, including real estate investment trusts, which is often an overlooked tax savings vehicle for real estate,
Hmm.
and limited partnerships. So everything is very dependent on your specific goals, on your specific strategy, and your risk tolerance as well, right? But that's a good idea too. Maybe we could dive into the different corporate structures or some of the more classic corporate structures for real estate
Right.
investors at another podcast.
Yeah, so I mean, but one thing that I wanted to get out of this is everybody's been freaking out around the flipping tax. As though
Yes.
it's something really new and thing, but it's not really that new. Like people are saying, oh, you've got to wait 3 years. Others saying you've got to wait 1 year. Others are saying the flipping tax is 20%. Like I've heard people say it's flipping tax 20%. And then that's on top of on top of your personal rate. All
Yeah.
of these myths are out there. So I wanted to for us to get rid of those myths, to say it's just drilling down on saying, this is actually on saying business income versus capital gains. There's no additional
Absolutely.
taxes that have been added to this or anything like that.
No, no, there hasn't been. The one change in the legislation, like I mentioned, is the 365-day
5 days.
rule. So
Yeah.
make sure to hold on to your property for 365 days, and just be aware, that you be aware of the example I gave of the difference between business income and capital gains, and if you're really trying to meet the capital gains criteria, then consider some of the tips that I mentioned earlier, so that you have a file. If you do get audited, you'll be prepared to
Mm.
to provide the auditor with some
And
documentation.
then on the corporations, it's not clear. It's not black and white. It's like you said, it all depends. Like if you're not, like you can't just because it's business income doesn't mean you're going to be taxed at that lower rate with those exemptions, like the 11 or 12%, because there's specific rules around having X number of employees.
Yeah, I mean, like I think that what's not necessarily clear is the distinction between business income and capital gains, because that's really been defined by the courts. There isn't a there isn't a definition under the income tax for business income versus capital property income. Um, but it is clear, like if you consult with a tax professional and you really make sure that they understand what your business plan is, they will be able to describe the tax consequences to you and help you find a way to mitigate them.
Right.
So when more red tape, more regulations, it I feel necessitates more and more, consulting and working closely with a tax professional to ensure that you maximize the opportunities that are available to you under the Income Tax Act.
And I guess it would be best to come to you before we even get into, like when we're looking at a deal, to come to
Yeah,
you first to decide, should we take it on a personal, on the corporate, like how should we structure before going ahead, buying the property and then coming to you, which would be like, would it be ideal to
absolutely.
come first? Like,
Absolutely. I mean, I think it's pretty essential to get some professional help before, so that you could design a strategy. It's always important to be proactive in these things and get advice before you enter the transaction, and because often after it's too late.
so a lot of people now, Matt, market aside, are now afraid of doing flips. Is it a bad thing to do flips for as part of our financial plan?
No, it's not. I mean, there's actually certain benefits that could be attributed to flipping, but they need to be designed, with a strategy, like a tax and accounting strategy in mind, right? So flipping is still, a valid business model, but you have to be prepared for the taxes that are associated with it. And you're in the business, right? The way that the federal government sees it is that you really are in the business of selling properties like inventory, just like people sell pens or booklets or phone cases like inventory. So you have to be prepared to pay the taxes that are associated with that.
Right.
Hmm.
That sounds good. So,
Hmm.
so the important thing I think is that a lot of us as real estate investors forget when we're running our numbers is to
Mhm.
include taxes in there.
Oh yes,
Because,
definitely.
like, so especially when it comes to the flipping right now, we need to think about, like, is this profitable after you've had to pay? Because when that tax comes out, is it still profitable?
Yes, exactly. I mean, uh, I think that it's very important to have up-to-date numbers of your accounting, like monthly reconciliations, and that, if you're, and that you understand those numbers, right? So
Mhm.
whether that takes, having, what I like to do is I like to offer either a monthly or quarterly tax review call for my clients where we could review the numbers that are up to date. um, of course, you need to have the systems in place to make sure you have those up-to-date numbers prepared for those calls. Um, and then, once we have the information available, it's much easier to be in a position to give my clients valuable advice so that they
Yeah.
understand, okay, that you might have this amount in your bank account, but you actually owe the government, half of that amount or more.
Exactly. So don't go and spend it all.
Yeah, don't go buy a new car. Don't buy, it's okay to spend the money in your bank account for business purposes. Usually,
Hmm.
there could be some HST or considerations there, um, but yes, definitely, like the amount that you have available to withdraw for personal use is something that you should pay close attention to.
Right. Awesome. So I think in summary, the flipping tax is not necessary, is not a bad thing. It's not even a new thing. It's just there was quite a gray area between business income and capital gains. And now the government is putting more definitions around that as to, how long, but yet there's still a gray area. So there's still things you have to prove. You may do the 365 days, but then you may still not qualify because you didn't do all the things that you mentioned, like you didn't live in the home, you didn't, change your residence address with CRA,
Mm,
schools, etc. So it still would fall on there. So, and that's the difference between business income and capital gains.
that's
Right?
right.
It's
Yeah,
not like an extra tax that the government is adding to people who are doing flips now.
it's not an extra tax. No, it's not. It's not. But I think that, people that are in the business of flipping homes and pretending and getting away with it under the principal residence exemption, that's kind of a loophole that the government is trying to close right now in an
Right.
effort to curb the housing crisis. Um, there's more regulation in the space, and more regulation means you need to get good advice, right? So that's really what it comes down to. You just understand, you need to have a plan, understand, what the tax implications are, because even in my example, to buy for 500,000, sell for $1 million after putting 200K into the property. Like, we're not talking about small numbers, even though the CRA is viewing it as business income. Like, we're not making pens here. We're not making iPhone cases,
So
so
it still may be profitable. It doesn't, like, in either situation. You just have to. So, I think one thing to get out there to everybody is that when you're doing your due diligence on a deal, like, so if you're looking at something to do a flip on, etc., part of your due diligence is include your accountant in that due diligence. Right. It's
uh,
not just the mortgage broker. It's not just the realtor. It's not just the contractor. Bring in your accountant, because so that they can help you structure it the right way. And then you can run your numbers based on like how much taxes you're going to have to pay to, and then you can see whether it's still profitable or not.
100%, 100%. I think that that it's key to involve your CPA because you want to have a plan. You want to understand what the goals are, and I think understanding the tax consequences behind these types of
Yeah.
transactions is essential to getting there.
Because a lot of people only think about the CPA being someone that's going to be there at like a tax time. I got to get my bookkeeping together. I got to get all my things. Here's all my receipts. Here's everything. Okay, now do my taxes. And that's the
Yeah,
only time they see their CPA instead of
yeah, yeah,
thinking about them as part of the due diligence process every time you look at a deal.
yeah. And so that's something that really frustrated me, in my career. And obviously everybody being disappointed when the amount of taxes that they owe far exceeded their expectation. But then I'm not really sure how they came up with their expectation in the first place, right? So I think it's really important to, if some people think that, well, it's way too expensive to consult a CPA like intermittently throughout the year. So that's where I really came up with this service where you can keep your books up to date and you could stay, proactive with us. We review the financial information. We provide quarterly tax calls so that, you can really stay informed and aware of your tax situation, all of the risks that you're facing. Um, and make sure that you're goal oriented and you cover your bases in terms of taxes.
I always, before every deal, I reach out to my CPA and I'll say, Ryan, I'm planning on doing this. Like, should I put it on a personal name? Should I put it under my corporation?
Yeah,
Like questions like that. Like, what does this mean from a tax perspective? If I do this, I always reach out before I purchase. Because
absolutely.
then
Yeah,
I know from a mortgage perspective too, whether I should go ahead and, because from sometimes it's better you get better deals on the personal, maybe for the mortgage, but from a tax perspective, it might have been better to put it under the corporation or the other way around. So I
yeah,
always like
definitely.
reach out on from
Depending
that
if you're,
perspective.
right now we're kind of just talking about residential properties, which don't normally, I mean, unless it's a new construction or it's been significantly improved, there's no GST or HST considerations here.
Mhm.
But there's definitely that to look into, or there could be significant tax savings from a sales tax point of
Mhm.
view. Hmm.
That's awesome. Thank you so much, Matt. Like it's great. It's helped me clarify what this whole flipping tax is about, because there's so many myths. Like I said, there are people that thought that there are people saying that it's 3 years, others saying 1 year to be considered flipping. Others are saying it's 20%. The
Yeah,
flipping tax is 20%, and that's on top of your income that you're paying. And it's just like there's so many myths out there, and what I got from them is just like there's just more definition of business income now when it comes to flipping. So
yeah, yeah. I mean, thank you for having me. I'm happy to clarify with your audience, try and help people understand, what these legislative changes are and what they mean. I think it's important to get the message out there. Sometimes the government doesn't do such a good job of it.
no, definitely. I know even from you guys, from accountants, from CPA's perspective, you have to go back several times to try to understand what it is this new regulation means. Or I remember the UHT, the underused housing tax too. I know that was like has been so much confusion around there. So I don't
Yeah,
envy your job staying on top of these things and trying to understand what it really means. So thank you so much. And I'm definitely going to have you back for more topics, because there's so many more things that, we need clarifications on. I know another one is the short-term rental expenses too. So I'd love to
Yeah,
pick your brain
that one's
on
super
that
important.
one.
Yeah, that's definitely something very important. Thanks
Sure.
again, Debbie. I really enjoyed our discussion, and I'm happy to have another talk with you about any topics that you think might need further clarification.
Good, definitely. So to everyone out there, if you like this podcast, please hit the like button on YouTube, and also subscribe, because I'm speaking to other, real estate professionals and real estate experts. So you can learn a lot and put together your strategy. So please subscribe and hit that like, and we'll definitely have Matt on again in the future. Matt, how can people get in touch with you?
Yeah, so you could reach me. You could set up a call with me really easily on my webpage. It's mogulcpa.com, mogulcpa.com, and find me on Google Maps and on the webpage. I'm always available.
Excellent.
Also, you can follow me on just about every social media platform: Instagram, TikTok, YouTube, and LinkedIn as well.
And I will edit in your contact information into this video for everyone again. Is there a cost for a consultation with you, Matt?
No, I do free consultations, and we figure out if I can help you and how I can help you before I charge anything.
Awesome. Well, thank you so much. Really a pleasure having you, and we look forward to having you again.
Thanks a lot, Debbie. All right, have a great day.
You too.